Today's episode of the Planet MicroCap Podcast is brought to you by Weinberg & Company, a CPA firm serving the audit and compliance needs of micro and small cap companies. Their technical excellence is validated by a long and stellar PCAOB record. Clients benefit from reasonable fees, reflecting their belief that your capital is best deployed for growth, not for runaway accounting costs. Weinberg & Company, an audited legacy of quality. To learn more, call Corey Fisher at 310-601-2200. That's 310-601-2200, or visit www.weinbergla.com. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome back to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 143. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rcraft@SNNWire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Now, I'm bringing you this episode from LA, not only in honor of the Lakers winning the NBA championship, but also in honor of our sponsor for this episode this week, Weinberg LA. Thank you to Corey Fisher and the entire team at Weinberg. You can go and find out more information about them at weinbergla.com. We are less than a month away from our next virtual conference, the SNN.Network Australia virtual event. Be sure to join us there. We have speakers, our sponsors are live on the website, and please make sure to register to participate. The event is November 9th and 10th, 2020, US Pacific time, and 10th and 11th Australian East Coast time. So for more information, please visit australia.snn.network and click register now if you'd like to participate. I look forward to seeing you all there. I'm pumped on the shows that we have for you this week from the SNN Podcast Network. First up on Avoiding the Crowd with Maj Suedan, we welcomed fellow podcasting extraordinaire on the show, Brandon Balow, the host of the Value Hive podcast. Brandon put out a great tweet the other day on how to avoid value traps, and we break down this graphic thoroughly. So you do not want to miss this episode. Check it out on Apple, Spotify, YouTube, or Podbean at avoidingthecrowd.podbean.com. And on In the Market Trenches with Gary Reby and Eric Fure, we also welcome a really awesome guest, Thomas Brazil. He is the founder and CIO of 507 Capital and has extensive distressed investing experience, having founded and run a distressed investing fund for 7 years prior to founding 507 Capital. As you can imagine, he's got plenty of war stories. It's a very entertaining show, and I highly recommend listening in. Thomas, he actually really hasn't been on too many podcasts before, and he has a very unique and insightful investing approach and process. And again, if you're listening to this and you'd like to share your war story on In the Market Trenches, shoot me an email at rcraft@SNNWire.com or shoot me a DM on Twitter at Bobby K. Kraft, BOBBYKKRAFT. Love to hear all your stories out there and share those lessons that you learned. You can hear this new episode on Apple, Spotify, YouTube, or Podbean at inthemarkettrenches.podbean.com. And the Investors Roundtable is back again this week. Tune in every Friday morning to watch the latest episode of the Investors Roundtable. This week, we're talking SPACs. In particular, what the hell's going on here? So who will be joining me to discuss this topic? You're going to have to tune in this Friday to find out. Subscribe to the SNN Network YouTube channel to be notified of each new episode. That's www.youtube.com/SNNWire. Now, for this episode of the Planet MicroCap Podcast, I spoke with Lauren Templeton. She is the founder and principal of Templeton and Phillips Capital Management, LLC. Lauren is also the co-author of Investing the Templeton Way, the market-beating strategies of value investing's legendary bargain hunter. She joined me on the Planet MicroCap Podcast virtual edition with Perth, Tolle, and Peterson, and it was long overdue to have her back on the show. If you had to build an investor in a lab with the desired intellect, knowledge base, capability, behavioral intelligence, and pedigree, I think Lauren Templeton would be the result of that. She has a wealth of experience from the many lessons that she learned from her father starting at a young age to her days working with her great uncle, Sir John Templeton. And in this episode, we cover it all. Listen and learn to the Templeton Way, the art of contrarian investing. I promise you will enjoy our chat. Thank you again for tuning into episode 143 of the Planet MicroCap Podcast. And please enjoy my interview with Lauren Templeton. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and joining me today is a very special guest. She was actually on our virtual podcast panel that we did back in August with Peterson and Perth Tolle, and it's way overdue to have her on to do her own individual show and interview. So with that, I'd like to welcome Lauren Templeton. She is the founder and president of Templeton and Phillips Capital Management. Lauren, thank you for joining me today. How are you doing?
Thanks for having me. Doing well.
Very good to hear. So we actually went through a few of the questions that I'm going to be asking you today on that panel. But today we're going to be able to flesh it out a little bit more with more follow-ups and hopefully not too much annoyingness for me. But we'll do our best. So I'd love to start off with your background and when and where did your passion for investing begin?
Sure. So I grew up in a pretty famous investing family. So my great uncle was Sir John Templeton, and his career was really hitting its stride in the 80s. And I was born in 1976, so the bulk of my childhood was spent in the 80s. My parents were local business owners in a very small town in Tennessee, and they were very passionate about investing. They decided that although their businesses were successful and they ultimately sold the businesses and did well, they knew how hard it was to make money, and they decided to get as much money out of the businesses as possible and invest it in the market. And that coincided with Uncle John's, career really taking off. He was on Wall Street Week frequently in the 80s, and I spent, my evenings watching Wall Street Week with my father.
Wall Street Week, that's a deep cut right there.
Yes, with Louis Rukeyser. And I still go back and watch some of those episodes. They're amazing, right? They all sit around in tuxedos, and it would be like Peter Lynch and Sir John Templeton and Louis Rukeyser, and God, I love it. But that's how I grew up, and my dad heavily influenced me when it came to investing. He allowed me to pick a stock per month. I could buy any stock in the world I wanted, and he would buy me one share and go down to the local Walmart and buy a picture frame that was pre-matted, and he would hang the stock certificates on the walls in my room. So I grew up learning about businesses. Really, that experience impacted me as an investor, because instead of looking at the stock market as a chance to speculate, I really viewed my ownership in these shares. I was a business owner, so I was constantly evaluating the businesses and their profitability, their prospects for growth going forward. How are they going to fund the growth? So it just changed my perspective. And then as a young adult in my early 20s, I was working at a hedge fund shop in Atlanta, Georgia, and received notification that my great uncle was going to fund a hedge fund for me with $30 million in seed capital. It came as a total surprise and was quite shocking, but I was able to work with him for about 8 years before he passed and learned as much as I could about him, his strategies. And in particular, I spent a lot of time focused on his trades that were more profitable in his career. And my husband and I actually wrote a book called Investing the Templeton Way, which profiles those trades. We wanted to go back and place the decisions in historical context so that people understood during moments of maximum pessimism, as he said. It's very hard to make these decisions and to be a contrarian and go against the herd. So I wanted people to first understand all the background behind the trades that he made. And also, we believe at our firm that to distinguish your investment returns, you really need to focus on your behavior in a bear market. It's pretty easy for everyone to do well in a bull market. Rising tide lifts all boats. But if you want to distinguish your return pattern over the long term, you should really focus on the opportunities you're given in a bear market. So that's what we were hoping to do with writing that book. My husband and I run a registered investment advisory firm. We have a research report called the Maximum Pessimism Report, which is available for free if anybody wants to read it.
Oh man, we have so much to unpack there, and don't worry. Anybody listening, I have questions for literally everything that Lauren just said. But as a quick follow up, when we were doing the panel, you mentioned that both your father and great uncle were lighthouses in your life. What would you say was the biggest difference in their investing strategy or philosophy? Was there a difference, or were they more or less the same?
Oh, and my father and Sir John? Oh, yeah, huge. So I would say their philosophy is the same, but the way they implement the philosophy is very different. So
interesting.
John Templeton was a stock picker. So he liked to analyze companies. Of course, this was before the days of Bloomberg and Microsoft Excel. So when you went to his office, you would see the big binders, the value line binders, for anybody who remembers them. And so he would get the supplements, add them to the binder, and that's what he would read. He would be reading all those pages and all the companies in the value line reports, and ranking companies based on their valuation. And I mean, he read a lot of research, but he also looked at value line. It's so different these days when you can download data on thousands of companies with one click into an Excel spreadsheet and sort that data. I mean, I remember very clearly one time visiting him in the Bahamas. I used to go down like every month, and it was one of our meetings, and he said, well, now I want you to go back to Atlanta and take these securities and rank them using, the PEG ratio and a 5-year growth rate if you can find it. And I said, well, I'll just do it right now. And, I did it. And he was like, what? Whoa. And I'm like, wow, we can do that now. It's amazing. So he was really a pioneer in the field because he had to search pretty far for his research. But going back to your original question, my dad, he believed in the same philosophy, but didn't feel that he had the skill set to analyze a specific company. I don't know if he didn't have the skill or he just didn't have the time. So he focused on mutual funds. So what he would do is find a good mutual fund with a good track record, and in a market, event where the market fell, he would add to that mutual fund. And he did quite well. I mean, mutual funds are hard products, right? They're terrible products to manage because people are always giving you money at the wrong time and taking it away at the wrong time. So if you're a value mutual fund manager, the market falls and people are redeeming, that's the exact time you need capital to take advantage of opportunities. So it's very challenging, but also from a tax perspective, they're not the best vehicles always to invest in. So I do think my father's strategy has evolved over the years. But yeah, there are lots of different ways to skin a cat, and the value lens applies to funds, it applies to stocks. There are lots of different ways you can take advantage of human behavior when it comes to investing in financial markets.
Absolutely. The main reason I wanted to ask that question is because, I figured, of course, you had the influence from Sir John, and in more ways than one. But also you speak quite eloquently about the influence your father had on your investing experience and philosophy and strategy as well. So it's really interesting to see what you took from John and your father and how you've been able to evolve it to where you're at today, which we're going to get into in detail in a little bit. You already went into detail a little bit, but we'll get more in detail later. But one question I also had, and you said a couple experiences now, but I mean, what were some experiences, and I'm sure there's countless, that you draw upon that really reflect your investing philosophy when you think about your relationships with both your father and Sir John?
Well, really the focus is just on value and on finding a bargain. We are very disciplined investors when it comes to deploying capital. And we have an investment discipline that we like to adhere to, a philosophy here in this office. And I think that's very important, because if you're not disciplined, I think it can be very easy to be led astray by your own emotions. So I do like having a framework. It might be mine, it might be somebody else's. There are all sorts of different strategies that might work, but you have to choose what is really best suited for your personality and have some discipline around your decision-making process, but also flexibility. So I know those are kind of opposite, discipline, but flexible. Uncle John was extremely flexible. So we watched him over time really change the different valuation metrics he looked at. Sometimes it was the PE ratio, sometimes it was the PEG ratio. In his famous trade, investing in 104 stocks on the eve of World War II. I mean, he was really a distressed investor. 37 of those companies were in bankruptcy at the time. So we've seen him use a variety of metrics. Here at this company, we do all the traditional value metrics. We screen and we really drill into the bottom decile of the market. But if you look at what has been most highly rewarded over the past decade or so, it's free cash flow yield. So we have been able to really adjust the emphasis on which metrics we're looking at for a certain industry or certain stock. So we have a framework that we're very disciplined investors, but we also have some flexibility within that framework to adjust the way we analyze companies. And I think that's all super important.
Couldn't agree more. I guess really what we're getting at here is, I mean, what experience would you say kind of led you to, okay, this is going to be our main focus? Or I guess maybe it was an investing experience or something that you studied from one of the trades that either your father or Sir John did. I mean, was there an experience that you're like, okay, I'm going to try this path, see where it takes us, and now we're going to take it here?
I mean, not really. The answer is I grew up in the Templeton family. We are value investors. It is it is not just an investment discipline. It's pervasive across everything in life. So yes. I always say, everybody loves to hear the stories of my childhood with my father, but I mean, he really did. And it's not a joke. I don't say it for attention. He actually told me bedtime stories about the magic of compounding, how the magic ingredient is time. And as a young person, how powerful that is. You don't have to have great returns if you just start when you're young and start investing young. The other thing he talked about all the time, which, I always kid, I'm like, this is child abuse, Dad. Everything was about the opportunity cost of decisions. So, I used to tell a story about how we had the ugliest Christmas tree in town because we would always go out to my aunt's piece of property and chop down a cedar tree. And it was always lopsided and ugly and haul it home. And, we would put it in the living room and decorate it. And my friends all had these, really perfect Fraser firs and these gorgeous trees. And so I would beg for a pretty Christmas tree. And I remember one day my dad loaded me up in his pickup truck and we headed down to the Christmas tree lot instead of my Aunt Grace's property. And he said, okay, go pick out whatever tree you want on the lot. And I did. And I came back and he said, well, how much is it? And at the time they were less expensive. I think it was $20. And he said, well, I'd be willing to buy this tree for you now for $20, or we could put the $20 in the Templeton Growth Fund that's compounding at, more than 14.5%. And, I've shown you how to do these calculations. So you tell me what this would be worth by the time you turn 65. And I would have to do that over and over again, whether it was a Christmas tree or, literally anything. So that is a Templeton quality, I would say. Sir John was the same way. During the Asian financial crisis, he had made a lot of money off of Kia Motors, is a stock that he bought. He had several different strategies taking advantage of the Asian financial crisis. One of which is a great story about him investing in the Matthews funds, Paul Matthews fund. And it had been the worst performing fund on record the year before, because this was during the years of the high flying tech funds, and it literally had the worst record. And Paul Matthews says, he said that things were really depressing in his office. Like they had even bought a ping pong table or something because they were so depressed. They were just standing around and playing ping pong. And, they had launched the fund at the wrong time. It was a terrible track record. And they got a fax from Sir John Templeton saying he's going to put in a lot of money into the fund. And the next year it was, I think, that the number one performing mutual fund on record. So that was one way he took advantage of the Asian financial crisis. But the other way is he bought Kia Motors, and I think my book may say how much money approximately he made on that stock. I don't remember at this point because I've slept since I wrote the book. But he always drove, a clunker car down in the Bahamas. And his assistant would say that she was embarrassed by him because he lived in this prestigious community in the Bahamas, and he drove this, yucky car. And so she suggested to him that he go down to the Kia dealership on the island to buy a vehicle. And he came back, and of course he was a multi-billionaire when this happened. And she said, Sir John, where's your car? And he said, well, they're too expensive for me. So I do think this is a Templeton quality, whether it's a car or a piece of furniture, a home or a stock. That is a philosophy that's pervasive in my family, to look for value everywhere. So I think you either have that in your blood or you don't.
I swear I've been since I started the podcast and learning a lot more about value investing and reading a few books. It's one of the simplest concepts and yet most difficult to implement. Especially when you're trying to evaluate. How do you really, it's easy. It's more or less, I don't want to say it's easy. Nothing's easy when it comes to evaluating stocks and putting a valuation on something. But then when you take just goods and services and products, it's putting a value to it. It's just that concept itself is just, you can take it any which direction you want. And, sometimes you think you might be going down the right path, and sometimes you might be overvaluing something, so
true.
It's simple in concept. And I'm jealous, quite frankly. I'm a little jealous, since you were a little girl, you were, it's in your blood, to really have this concept.
I think so, but I think most people can understand the concept of value investing and improve their results by focusing on their behavior. And I do think that's something you can learn over time, which is not only, compounding is magic. The magic ingredient is time. You should start early. But, you can also improve your results by focusing on your behavior and learning about your behavioral biases. And the way to do that really is to put capital at risk during these scary moments and reap the rewards, and do that over and over again. And then you'll eventually get to a place where I am in my life, whereas I love a financial panic. They're exciting for me. I start to get really antsy when the market's just going up and there's no volatility there, because it's harder for us to locate opportunities. But there's usually a good panic out there somewhere, and we've played the swine flu crisis, and I think we've researched like crisis in dog food and all sorts of different things. But I do think it's a skill that investors can hone themselves. It just is a painful way to do it.
Yeah, I mean, I did an interview very recently with a gentleman named Ben Clairman, and we talked. We talked basically the whole time about this idea of contrarian investing, and how basically contrarianism and value investing might as well be synonyms, because it's kind of how you have to think when you're trying to find some value, So, and I think you actually recently did, I think it was either a talk or an interview talking about crisis investing, and I think it had to do with kind of the March 16th timeframe even of this year. I mean, what are some of for those who, it seems like each new crisis and each new downturn is a whole new, like, whoa, this has never happened before. And I mean, with the pandemic, I mean, this hasn't happened since 1918. So there's generations of people that never experienced something like this. But, whether it's .com bubble or, COVID-19 pandemic, the GFC, I mean, geez, can you, all the things that have happened in the last 20 years in the markets, it's kind of incredible. What are, from a behavioral investing standpoint, because you actually taught a course on this for 2 years at the University of Tennessee, Chattanooga, what are some of the things that as an investor you need to really keep in mind to kind of either keep your cool to then take advantage of the opportunities, or that's a good question. How do you keep your cool to take advantage of these opportunities?
Well, some of that's just experience, right? So when I was young, I would get very upset and, would go home and go to bed, and it would be very upsetting to me anytime there was a market event. But you learn to take advantage of them, and reaping the rewards makes you look forward to them. But even the most seasoned investors really sometimes get nervous. I was pretty rock solid during the great financial crisis. I always say I was pregnant at the time, and I just thought, well, who knows what's going to happen here, but I'm about to have a baby. And that's what I'm focused on. So that was an easy one for me to manage. COVID-19 was nerve-wracking for me personally. I'm a hypochondriac, and I was actually sick during the early days of the pandemic. And so I was convinced that everybody in my house had COVID-19 and was worried about that. But we were taking advantage of it here in the office. So we did a lot of trading during March and April to restructure the portfolios and take advantage of opportunities. We actually became more concentrated. So the opportunities came and went pretty quickly in late March, early April, the really good opportunities. And I always tell people to prepare yourself for these opportunities. You should really maintain a wish list of securities in your desk drawer. These are companies that you've read about, that you've done some research on, that you would like to own, but valuations are not going to allow you to own them at that particular point. We have some kind of dream companies that we've been following for years that we've said, gosh, I so want to own that business. But it, doesn't fit into our discipline. And we adhere to this discipline. So we keep this list, and it is a real list in our desk drawer. And Uncle John did the same thing. But so during moments of market panic, when even the most seasoned investors are worried about their performance, the loss of capital, you can really shift your mental focus by pulling that list out of the desk drawer and then start focusing on the opportunities. And I say this in almost every interview I give. It is a palpable shift in energy. And it's just so powerful when you quit focusing and thinking about the money that has been lost and how scary it is and all the unknowns that we all worry about during those panicky moments. And instead, focus on the opportunities. And it makes all the difference in the world and gives you the conviction to put on trades that maybe you wouldn't without that list, right? So these are companies you've researched in advance.
Yeah, I love that advice. Because I'm assuming you make this list regardless of price. You just don't even care. You're like, right. I just want to find the best businesses. I'm going to make a list of them. And if there's an opportunity, go for it there. So I do a lot of interviews with, small micro nano cap investors on here. It's MicroCap Podcast, and a lot of these investors, when they love a business, they don't care. They just love the business. And yes, of course, they want to get in at the right price and all that. But at the end of the day, if it's, not a huge spread, or they're like, I just love this business, even if it might be valued a little bit higher than what I'd like it, I'm going to go and buy it, So what do you say to the investor that, and now we're just talking just in general, not talking about crisis investing, but just in general, especially for those investors that have that 3 to 5 year time frame, what do you say to those investors where, they just love that business. They want to get in at any price because they just see, that there's great kegger in that 3 to 5 year range. Do you still invest like that as well? Or are you really just sticking to that discipline of like, well, I love this business, but at that price though?
Yeah, we adhere to a discipline. So, no matter how much we love the business, we won't buy it unless it's priced right. And I always say that's really saving me from myself, because Sir John, he was pretty careful with the way he calculated things, but he spent a lot of time thinking about it. And he was known as the world's greatest stock picker. And he said that he was right about 60% of the time, which meant he was wrong 40% of the time. And he was one of the world's greatest stock pickers. So I figure that I am right, much lower than 60%. And so it's very important for me to adhere to a discipline. So I'm always, I'm not letting my emotions drive the process. I would be worried if you didn't have some discipline around your investing framework, that you would fall in love with a security, right? It's really easy to listen to management and forecast out all of this stuff and be a little too optimistic about it and not have any guardrails up or margin of safety, which is a term we use a lot in value investing. And I think it's pretty important. So we actually look for about 50% margin of safety, which is huge. A lot of value investors are in that 30% range. I'm less confident than the average value investor. That could be because I'm a female. They say women have higher investment returns simply because we don't trade as much and have less of the transaction costs that weigh down our returns. But yeah, I would stick to a framework.
So I have to ask, how would you say your investment criteria, the Templeton Way, how is that discipline and that criteria when you're evaluating a potential investment, how has that changed over the years? Have you evolved it over, to adjust to, I guess you say the 21st, or what are we in the 22nd century? How does that, I guess 21st century, right? I think, yeah. Or 22nd.
Well, it's constantly evolving, right? So it depends on what's going on the market. Like I made some notes to really, to think through how Uncle John's investment discipline changed. So when he started his career, he was investing in the 1950s and 60s, and he was focused on Japan, right? So none of the rest of the world was focused on Japan, but he was focused on Japan. And what he was really doing, and those investments were driven by accounting anomalies. So he was adjusting balance sheets and he was calculating a sum of parts. And then in the US bear market in the early 1980s, he focused on valuing firms on replacement value. And again, I said earlier in the podcast, on the eve of World War II, he was more of a distressed investor. So he went and bought 104 companies trading on U.S. stock exchanges that were trading for less than $1. 37 were in bankruptcy. He did it with $10,000 worth of borrowed money. And he did quite well, and is very well known for that trade. And then in the tech boom, I watched him short tech stocks. So in that market, what he had done is he was focused on IPO lockups. So he knew that even the insiders of these tech firms would know that their companies were overvalued. And so he would look up when the IPO lockup expiration was, and he would short the company about a week before IPO lockup expiration and cover about a week later, because he correctly assumed that the insiders would rush to sell the shares at these lofty valuations. And that worked really well. And then I watched him take a lot of the money that he made from the shorting tech stocks and deploy it into treasury strips using borrowed yen. So that was a trade that he made. And he was so flexible. We have followed the same path. So there have been times where our investment portfolio really follows more of the classic Graham and Dodd approach. And there are times such as now where we're focused more on free cash flow yield. During the market sell-off in March and April, we had the opportunity to really change our portfolio and buy stocks that value investors typically don't get to buy. So, we deployed capital into Amazon in late March and early April, which is not a typical stock for a value investor, but it touched lows that we had not seen since the great financial crisis. And it was a great entry point into Amazon. So our strategy does change a little bit and will continue to change. There will be times in the future where we focus on different metrics depending on what's going on in the market.
So my next question for you, and as a value investor, there's so much qualitative due diligence that value investors do, you do. And, you actually have a unique position where you also sit on some public company boards. So you get that upfront experience where you're not just evaluating how current management is doing, but potentially even looking at new management to bring in and to really understand some of the good and the bad traits that go into some of the more better investments that you're looking for. So what are some of those good and bad traits that you look for when you're evaluating management?
When you're talking about the qualitative side of investing and you're evaluating management, I think you really want to be focused on management teams that can answer the question, what are your long-term strategies for creating shareholder value? I'm always worried about management teams that are focused on the next quarter, right? Because it's very easy to manipulate earnings, and from a research perspective, you have to have your eyes open and know all the accounting gimmicks and tricks that companies can play to manipulate earnings to get from one quarter to the next. And I would say that would be a very low quality company and management team that relies on those. So we like to see management that is focused on the long term and value creation for shareholders over the long term, and less myopic and focused on next quarter. So that's always really insightful. Sometimes when you speak to management and you talk about the long term and they're like, that's a pretty good sign that may not they may not be long-term focused enough for us.
Absolutely. And, I can't believe I've never asked this question before, but I'm going to ask it anyway, because I'm assuming you had experience with management teams, both large, mid, small, micro, across the board in terms of market caps. Does good or bad management, does it change across the board? Or when you're looking at a good microcap manager, are they doing more or less the same things as a good, mid, large cap manager?
Yeah, I think so. I think management is management. It's all about creating value for shareholders and how smart they are at capital allocation in their business.
Yep.
So that doesn't matter, if you're micro cap, if you're large cap, it's all about returns to shareholders, I feel like. So it's the same. I don't think it matters whether it's micro cap or large cap. For
sure. I agree 1,000%. I had a feeling that was the answer, but I thought I'd ask. Why not? So one of the ways that we actually met was through Maya Peterson and her incredible book, Lighthouse, Women Leading the Way in Finance. I invite everybody to go get your own copy. You're featured in there, and that's how you came onto the panel that we did back in August. And in there, she highlights your passion for financial literacy and teaching value investing, which we discussed earlier. You taught a behavioral finance class at the University of Tennessee, Chattanooga. So here's a two-part question for you. Really, what does behavioral finance mean to you? And then the second part is, how can we continue to get the message out there about the importance of financial literacy?
Okay, so behavioral finance to me just means human nature, right? So the psychology behind your decision making when it comes to financial decisions. That is what I think of when we talk about behavioral finance. So people have all sorts of biases as human beings. And a lot of those have been quite helpful as we have evolved. When you think about a caveman sitting in a cave, when the guy gets next to you gets up and starts running, you maybe should run too, right? That might be helpful. There might be a bear there or something like that.
Probably, yeah.
Yes, but in financial
unless you're a contrarian, and you're like, that bear's not that big. No.
But from an evolutionary standpoint, these things have developed. The way we process information has developed to keep us alive.
Sure.
And that is not very helpful when it comes to navigating financial markets. So I love the study of behavioral finance. I think it's endlessly fascinating. I love to read James Montier's work on that. He's got some great books describing all the biases and how the human brain works, how we process information. You have different areas of your brain. And really, the human brain relies on this little piece right at the front of your brain called the amygdala to process a ton of information very quickly. And to process that much information so fast, information you're not even aware of. I think we as humans are conscious of about 40 pieces of information per second. But I forget how many bits of information the human brain actually processes, but it's millions, okay? And so when you're talking about taking in that much information, your brain has developed all these mental shortcuts to help you make decisions and basically stay alive. And these shortcuts are what really will get you in a lot of trouble when it comes to financial decision making. So that's what I think of when I think of behavioral finance. Really, I think reading a book on behavioral finance improves everyone's returns because you start to notice that you have some of this behavior. Mm-hmm. And it may be hard to override that, but you're at least conscious of it. So I find myself all the time going, oh, no, I'm anchored, or, I'm using mental accounting. And it makes you aware, and it can improve your investment returns. I don't remember your last question.
The second part was talking about how we can continue to get the message out there about the importance of financial literacy.
I don't know. I love the idea of all young people being financial literate. It is hugely important, right? That's a gift my dad gave me that, wow. I mean, what a gift to give your child. And really a lot of children never get that. So, I don't know, but if somebody has any great ways of increasing financial literacy in youth, please reach out to me, because I am very passionate about it. I think every child should learn about it. My dad always told me, you're going to deal with money your entire life. You can't opt out of the money game. You have to know how to play it, whether you're a doctor or a school teacher or you invest in the markets. So these are important concepts to learn about compound interest, to learn the positive compound interest, but also negative compound interest. So what happens when you have credit card debt? Mm-hmm. So these are little decisions you can make early on in your life when you're young and you don't know better, that can have a huge positive impact or a huge negative impact on your life. And I feel like as a member of the financial community, we have this responsibility to educate young people and give everybody the opportunity to start out on solid ground with their financial decisions.
Well, hey, let's go on 20 minutes. Let's spitball right now, because the number one thing, because I think about this concept a lot too, especially, one of the reasons I started this podcast is that I wanted to become a better investor. And I wanted to interview people way above my weight class. I still continue to do, because, that's just, I do. And the main thing I think about a lot when it comes to financial literacy is, you think about, all right, do we create games for kids to talk about, finance concepts and this and that, but just hearing your story and hearing the effect it had on you, it's a different type of network effect that you have to really think about is, well, what if there was just a fun, easy way to teach the older generations about money, get them passionate about it a little bit more, so that then they could, or just teaching them how to get passionate about it to then teach their children about it. I don't know, because whenever I think about, high school courses or middle school or even elementary school, in theory, we like, oh, great, we need that. This is great. We want it, in the classroom to be teaching about money and just understanding the stock market and compounding interest and all these important concepts. But at the same time, you're like, all they're thinking about is recess, and lunch. So, and they're just trying to figure out math right now and history. Now you're throwing that, and not to say they don't have the capacity, but at the same time, it's, I think really where it could have the most effect is in the home. You're a prime example.
Sure. It is, the best way to talk to young people is in the home, and it is with the parents. But unfortunately, a huge percentage of our children don't have that opportunity because their parents aren't educated, or maybe they're working 2 jobs and just don't have the time to do it, or they've picked up bad financial habits in their life and they're going to pass them on to their own children. So there has to be some method outside of the home to give all kids an education in finance. You don't have to teach them about investing in the stock market, but the concept of compound interest and saving and being responsible stewards of capital is so important. And so I do think there's a place for that in education, maybe not K through 5 education, but certainly in middle school and high school. Because these kids are going to roll out of high school and then have to pay for college, and they're going to go take out a student loan. Half of them don't even know what they're signing up for. So, we should make an effort, I feel like, as society, to educate young people about financial terminology, make sure they're financially literate so that they can navigate these waters post high school. But for sure, if you're a parent sitting at home, it is easy to do in the house without it being overwhelming. I mean, my kids get a healthy dose of it, and I really think if you taught to them, they don't even notice that I'm doing it. It's kind of like I'm putting peas in their ice cream. I just happen to pickle in some financial language, and like my oldest. I'll tell you this, and you can cut it off if I'm going over. But
no, keep
my
going.
oldest during the crisis, so she started making these lanyards that you could put a mask on, right? So it would hold your mask on. It's like a necklace, and it holds your mask on. And she asked me to buy some beads for her. So I did. I went on Amazon. We discussed how much the beads cost. And then she and her friend went to sell these lanyards. So we had, a talk about, cost of goods, the margins. We talked about taxes and, how hard it was to make the money and be able to charge the right price to really cover the true cost of manufacturing this lanyard. And what she was going to do with her savings. Did she want to spend it? It was so hard to make, or should she let it grow? And then the other thing I'm considering doing, which I haven't done right now, is just setting up a Venmo account for her and linking it to a bank account so that as she does chores around the house, I can quickly send her money. Because what happens at our house is I'll say, oh yeah, I'll pay you $5 to do that, and then I forget to do it. And so the incentive is gone. But I think, rewarding your children for hard work and making them learn what hard work is important as well.
I agree. Look, Lauren, whenever you're ready to start a YouTube channel and then an Instagram presence, I think there's a real opportunity of just explaining, what you've done and how you've taught your children, and then also the experiences you had as a child. Look, I'll be a subscriber.
Well, I have thought about that, and I don't have time, right? So
I know. I was going to say you're incredibly busy, but the minute you do decide to do that.
Well, I've thought about how Maya and I should probably team up to do that, right? Because she is an amazing example of a young person who is really understands all of that, and she might be able to get the message across to young people a little bit more effectively than I could. She is such a rock star, I feel like, for a young person her age. And I do have, I have a folder full of articles that my dad has given me over the years. It's about this thick, and it's called the Dad File. I've got it in my office. He still sends stuff to me, and I put it, oh, that's cool, I'll put it in the Dad File. So over the years, when young people really around the world, they have written me about investing, I will often copy or scan the Dad File and send it to them. But it's just got so many different articles that young people can read, and it's an easy way to understand investing and money. That I've just compiled these my entire life. But he's good at doing that for me.
I'll tell you right now, like I genuinely would be a consumer of that, because as much experience as I've had in the stock market and in investing and talking with incredibly brilliant people like yourself, that's totally different than then looking your child in the eye and saying, okay, money, markets, debt, I could go off forever, so there's an art to it. So whenever you're ready to do that, I will be the first a customer of that. So
okay, well, that sounds good.
Okay, good. So we're at that point in the interview where these are my favorite questions to ask. And so what would you say is an investing experience that impacted your career the most?
Impacted my career. I've had lots of investment experience, and I've made a ton of mistakes that impacted my career the most. Really, just learning to buy things at the bottom of the market in a variety of financial crises and events in the market, and benefiting from that. That every time you do that, it just solidifies that in your brain that this is how you make money, and it gets easier and easier.
All right. So what was the first time that happened? So you were like, oh yeah, I'm going to do this from now on. This is the way.
I mean, I don't even remember the first time because I've been investing for so long. It would have been when I was 7 or 8 years old. I mean, I very vividly remember the 87 stock market crash. Mm-hmm. So I would have been 11 years old. I remember being, this I'll tell you a little bit more about my family. So my dad in the 80s, he decided to sell his business. He and my mom went and studied investing full time. They went back and my mom got her degree in accounting. They both sat for the CFA examination. My mom is not an accountant because she doesn't have the work experience. She was already retired. And you have to have a number of years of work experience. But she made one of the top grades in the whole nation on the CPA exam. So they did that after they sold their businesses. So they were studying investing full time. And there is a city about an hour from our small town called Huntsville, Alabama. And there was a brokerage firm there, Dean Witter Reynolds. And my dad went in and said, I want to work with you for 2 years. I want to get every certification that you'll let me get just to learn about this industry. And then I'm gone. Well, he was there during the 1987 stock market crash. Wow. So mom and dad, they'd already sold their businesses. They had everything invested in the stock market. And dad was working at a stock brokerage firm, and 87 hit. So I remember being in the den of my parents' house and my dad coming home from work and him asking my mother to step outside of the den and close the door to the den. And he told her that they had lost half of everything they'd worked for. And I don't remember my mom having a bad reaction. They instead viewed it as an opportunity. My dad said he was the only buy order that went in the whole firm that day. That there were brokers that really focused on options that got up and left the office that day and never returned. Like nobody saw them again.
Wow.
They just left. So that, although it wasn't me investing directly, I remember that moment and it not being a scary or a sad moment at our home. Instead, my dad was focused on the opportunity, and I don't know, the one stock he bought that day or whatever it was he bought. I don't know if it was a fund or a stock, but he said he had the only buy order. Also in 87, my husband and I have written various things. He's actually written 3 books, and in one of them, we went around and interviewed people all over the world that had worked with Uncle John. And in the interviews, we talked to his now not so young analysts, but the analysts that were working with him on the day of the stock market crash in 87. And they said the market was tumbling, and he always exercised. Every day he would go for a walk in the surf for an hour at Lyford Key. He was very specific about it. He even had his shirts hemmed so that the water wouldn't hit them and he could cover up without getting a sunburn. But so it was time for his lunch and walk, and he got up and he left the office, and they were like, what is he doing? The stock market is falling. So he came back in from his walk, and they said they ran up to him and they were surrounding him, and they were like, Sir John, the stock market's crashed. It's just crashing. And he said, boys, sit down. And he said, I've got good news and bad news. The bad news is we're in a bear market. The good news is it's almost over. Please have your stock recommendations on my desk this afternoon for us to place buy orders. And then we've also interviewed the brokers that took those orders that day. And he also was famous for saying on that day, this is going to make our returns for years to come. And he was correct. So, although I wasn't there, I didn't have that experience. I did have the experience of my dad on the crash of '87, remembering it vividly and seeing it as an opportunity instead of focused on the fact that I'm sure it must have been a lot of pressure. They had just sold their businesses and he lost half of everything. That's not something you want to tell your wife.
I'm already thinking of the title for this episode, and it's going to be The Templeton Way, the ultimate contrarian. I think that is just a perfect way.
Well, there is a great documentary called Contrarian. I think you can look it up online, but it is about John Templeton. Mm-hmm. So it's definitely worth watching. It's a really good documentary. Yeah.
Very cool. So we're rounding the bend here. My second to last question. The last question is an easy one. They're all. I don't think I threw any curveballs today. I don't usually. My curveball's not very good anymore. But what advice do you have for new investors out there looking at investing in the stock market?
Mm-hmm. My advice would be to open a brokerage account at a discount brokerage firm and just start investing. I think that people spend an awful lot of time reading and preparing, and I don't want to take anything away from that. I mean, it's important to do that. But people get really overwhelmed very quickly when it comes to money and finance, and they just don't ever do it. They sit and study, or they're too intimidated by it, so they never do it. And then they, rely on experts. And I mean, I'm an expert. I'm grateful for my customers, and we're always looking out for our customers' best interests. But, we all know that not everybody's like that works in the financial markets. So you need to know what you're doing yourself. And the only way to really learn is to put some of your money at risk and just go for it. Now, I'm not recommending that you take your whole life savings and open a brokerage account and start trading. But, buy a stock. Buy a stock and start following. Buy one share of a company that you think you like and start reading about it. Because when you have the money actually at risk and invested in it, then you'll really start to read and follow the company news, and you'll learn as you go. I think that people get way too intimidated when it comes to investing, start too late in life, and they lose the number one advantage that you have as an investor, which is time. That is the thing you have the most control over. So the earlier you start, the better.
Well, I think that's a great way to end it right there. So Lauren, where can my audience go and find more information about you and Templeton and Phillips Capital Management?
Yeah, well, we have a website. It's not the best. It's not our focus, but TempletonandPhillips.com. I'm active on Twitter at LC Templeton. I'm on LinkedIn. So feel free to reach out. And our maximum pessimism report is periodically produced. I'll say.
I love that word. Yeah. in the media business, periodically is the best.
Yeah. We used to be monthly. Now we're periodically. It is really hard to come up with something new to say every month. But when we do put out a report, it's usually full of tons of good, useful information, and it is free.
Very good. Well, Lauren, this has been an absolute pleasure. Thank you so much for joining me today. I really do appreciate it. Stay safe. Good luck. And I look forward to chatting with you again soon.
Yes. Thanks for the opportunity.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.